principals in their trading and investment activities, and not just as market makers, lenders, and advisors. So that is, there's clearly a change that's happening in what banks are prepared to do, and I want to speak a little bit more about what that means, turn our discussion to what that means for the availability of financing, which has always been one of the basic functions of banks, but also one in which alternative capital providers are increasingly active. So to kick off this part, I'm going to turn the first question to Bennett, which is that pre the financial crisis, banks and brokers traditionally provided the role of giving certainty of financing. You had a little bit of a role in that market, being probably the leading player in that market for a long time on the bank side. But it was the provision of the certainty of financing to corporates and to private equity firms for acquisitions and investments. That's clearly changed a bit in the marketplace, and there are alternative providers like your own firm who are doing some of that work. Can you comment on how that has changed, and then we'll follow up and let Kerry speak about that from a bank perspective?
Sure. I should probably start by hearkening back to some of your slides about where the banks trade. And part of the reason why the banking community today trades at a discount to tangible book value is because they can't really show the shareholder 12, 13, 14, 15% return on their equity. And that's because their capitalization's all out of whack. And ever since the financial crisis, the banks have been scrambling to interpret what's going on in the regulatory front, but also to rationalize their businesses. And the pervasive conclusion for the industry is that they have to move more towards a capital-light model. They can't extend their balance sheet every time a client needs capital. And in that context, what has happened is not only have the banks reduced the size of their balance sheets, they've gone to a model where they're really in the business of syndicating risk, and the institutional investors, the alternative credit managers, are really in the business of owning that risk. And in that context, if you can syndicate a deal and earn your 3% fee and put up no capital, your return on equity very, very high. Why bother making a $500 million bridge commitment where you can make a point if you're right, so you can make $5 million. But if you're wrong, the market moves, the economy slows down, your recovery on these $500 million bridge loans can be less than 50 cents on the dollar. So the asymmetrical risk reward of some of those capital commitments, you can make $5 million on a $500 million bridge, or you can lose $250 million. You don't have to be a genius to see, well, look, let's try to mitigate that risk by being more proactive in syndicating. And what we certainly have seen since the collapse of Lehman is just a lot more collaboration between these alternative managers that have big capital pools and the various commercial and investment banks in terms of that process of capital formation. And it's really critically important for those of us on the buy side to have a successful, vibrant, and growing banking industry. We need the access to the paper. We couldn't possibly manage client relationships. That's what banks are really good at. These clients don't just always need credit. They need M&A advice. They need equity offerings. They need to do swaps if they're global businesses. So it's really important that we have a thriving banking industry. And I think in light of some of the changes in the quest to get a 12 to 15% return on equity, the capital formation process is changing a little, where there's much closer integration between the bank making a commitment on behalf of a client and institutional buyers like us trying to own that risk.
Josh, did you want to comment on that?
Yeah, if you were Martian and you came down and you looked at these regulations, you said, well, no, and no one told you why they were there because you weren't backward looking. And somebody said, okay, I think the purpose here is to have much less liquid capital markets. I think the purpose is to have less capital availability for growing companies, and to take the less efficient, less transparent parts of the capital market, so for example where we live a lot, which is non-investment grade debt, which has never been a market that's worked particularly well with electronic markets or things like that. And so let's try to take those markets, and now that they're less liquid and less transparent because the brokers can't use any capital to support those markets, we know that the spreads are going to be wider, which means there really will be higher profits in trading them, not lower. It just won't be owned by the bank. So let's make the hedge funds who do credit trading, particularly the larger ones, more profitable while having less capital access to companies. That's what it looks like the purpose of the legislation is. It's kind of wacky because you've got higher capital charges to banks so they can't support the inventory. You've got the Volcker rule, and you've got all sorts of transparency requirements. So you cause a big backing off from those markets. And then when you get debt that starts to mature, bank debt in places like Europe where the capital charges are particularly high, I think you'll start to see other intermediaries take over that lending function because the banks really will want to back off. And the cost will be 500 or 800 basis points of higher borrowing costs for companies that need capital.
So, Kerry, do you want to give a perspective on that? I mean, we're still, in a sense, in early days of the recovery in the deal business, because if you look at deal volumes, we're still not seeing anything close to the level of leveraged activity that we saw pre-crisis. And what Bennett and Josh described is clearly all true, where the clients are, in many cases, stepping up to provide some of the commitments and the financing that banks heretofore provided. But banks aren't out of that business, are they?
No, but again, I think the points that they both made are spot on in that, you have to go back and, the banks, somewhat lost their way from a risk management perspective. And I think there's far greater focus now on what Bennett said is what can go wrong. So, if there is, and there continues to be capital extended, whether it's in lending activities or bridge activities, but you'll see the banks much more aggressive about selling down a bridge loan, for example. So, whereas if you were looking at, ours or other banks' balance sheets in 05, 06, 07, you'd have a series of, very large concentrated exposures. And, again, you would think, okay, I'm going to have this for 3 to 6 to 9 months, depending on how long it would take to ultimately do the transaction in the public markets, which is going to be the takeout. I think after having gone through that experience, there's far greater focus on, kind of on a portfolio basis, what's the aggregate exposure, or just for a single obligor, what is that exposure? So you will see, whether it's the banks, teaming up much more willingly so they have smaller exposures, or again, literally syndicating bridges to our clients so that, again, we're in the moving business. Bennett, and Josh are in the storage business. And I think, what happened was that line started to get blurry a little bit. So, banks are still in the business, but I think, some of the points that Josh made are spot on, is that Basel, Dodd-Frank in an odd way make it more difficult to lend, in the sense the regulation wants the banking industry to lend to IBM and GE, who in your slides it shows borrow at lower levels than the banks do. And the companies that do need that capital, it's going to be hard for the banks because as you look at the amount of capital we have to hold against it, it's going to become much more expensive or costly if the banking industry has to provide that capital to those companies. And I think ultimately you'll see, again, a further disintermediation because, Josh and Bennett will create products that, are more reflective of the economic risk rather than the regulatory risk that, we're forced to hold against. So I think some of this in the near term will be, higher cost of credit, less availability, but I think ultimately, again, our clients will create products that, somewhat replace the banking sector to a certain degree.
I want to go back to Josh's analogy of if you were dropped in from Mars today and you took a look at some of the regulation, and I'll ask the Congressman to comment that clearly one of the challenges is that the markets seem like some of the trading markets are less liquid. It seems like it's harder in some respects for growth companies to access capital. And recently one of the few things that's gotten through Washington is the Jobs Act. And I guess I'd like to get your perspective. You've been both a lawmaker and now you're working on behalf of industry. Just your perspective on what you think the potential is of the Jobs Act. Is that really going to change anything?
Just a quick historical narrative. The Martians have been running things for quite a while. I would take you back to the mid-'80s as we're sliding down the tube in the S&L crisis. Congress reacted with the creation of REFCOR, an institution created to maximize taxpayer loss and ensure that recovery took as long as possible. That was then followed by a reaction by the regulatory world that led to the credit crunch that affected primarily the Northeast. The Congress then pursued an effort to get regulators to loosen up a bit, help small business in America grow and prosper, and that led to a period of time, simplifying matters, where a decade of growth and prosperity that led the Republicans, for which I take full responsibility, to suggest in Graham Leach Bliley that we should take the barrier down, unleashing unprecedented growth, which was then followed by WorldCom and Enron, which led to Sarbanes-Oxley, which then put the accounting burden back on business and slowed the potential. However, business found innovative ways to outsmart Congress, which is not unexpected, began to diversify as a result of the absence of the Volcker Rule, took on more risk, and a slight contrast with some of my participants. The outcome of that was insured depository institutions who had a direct link to the taxpayer's pocket found themselves over-leveraged and underwater. Then the senator had to take the appropriate response. I was gone by then in 2008. Fortunately for me, not so much for the senator. And get the 15 to 1,000.
You're smarter than I am, Richard. You left sooner.
Faced with the inevitable problem of having to dig our way out of this mess with very unpopular responses, because we're again taking taxpayer money to bail out the missteps as viewed by the public in Wall Street. So it's not a mystical process. It's just not logical. If you're looking for a logical explanation to congressional steps, you're looking in the wrong place. The Jobs Act certainly may help. I think the macro picture is much more important in whether consumers have confidence in the functioning of the market and whether investors are willing to put their money into deals that may not be as transparent as they like. So I think the future is really in the macro hands of the American people, and whether they think Congress has acted responsibly, that there is a change on Wall Street. And by the way, just to correct any misperceptions, hedge funds are regulated, and when they go out of business, there is no direct link. They simply die, and strange people take your furniture. So there's a very logical thing that's going on here.
Though.
Well, you know, I can see them in my mind's eye. The point is that I'm not confident that Congress will inevitably draft the right construct for markets to perform efficiently. And I think participants who engage in Washington can help them find a better path to rational thought.
We'll talk about more of the changes in Washington and the regulatory actions in a few minutes, but I guess I want to turn a little bit I want to get some of Tom's input on technology. Clearly, one of the things that's changed over the last 25 years and represents probably a growth opportunity for Wall Street is the increased use of technology in the business. We've clearly seen in the equity trading business technology really become the basic tool for large parts of the business, and that's changed a lot over the last 25 years. So can you comment on that change and then give us a little bit of sense of where you see that going?
It's changed a lot over the last 25 years. It's more particularly changed a lot over the last 8 to 10 years. And I think it's an interesting way to look at it is how the competitive pressures that technology can assert on the marketplace will be accelerated when the regulators get involved. And our firm has a broad business, but we're probably best known for the equity business that we're in. We're a pretty large market maker in the U.S. About 8 to 10 years ago, the SEC passed something called Regulation NMS, National Market System. You'll be happy to know that it was a description as to how one can trade equities, and it's over 500 pages big. I mean, we needed a 500-page book to understand how to trade equities. So that was kind of disheartening when it first came out. Having said that, it didn't just encourage the use of technologies, it kind of mandated the use of technologies. So what's happened since? Well, I think there are two interesting data points to look at to tell you just what an impact it had. When Regulation NMS was introduced, the exchanges had crazy market share. The New York Stock Exchange at that time had about 90% market share. NASDAQ had an outsized market share as well. But we have these two converging lines that we've seen over the last decade. Market share was up here for the exchanges. Execution quality for the retail investor was down here. Over the ensuing 8 years, the market share for the exchanges, and this is all due to technology and the competitive set, the exchanges market share has dropped to about 25%, from 90 to 25% in about 8 years. The execution quality for the retail investor has gone from